up ahead. Affirmative 612.
This week on the Wealthy Pilots podcast, Scott, the market is expensive. So what do we actually do? We're setting all-time high records on a regular basis, and people, we talked about fear of missing out a couple weeks ago. We want to be doing things, but what's the right things to do when it's when we're not supposed to, buy high? We're supposed to sell when it's high and buy when it's low.
Yeah, I mean the buy low, sell high obviously sounds great all the time, and it can be challenging when there's nothing to buy low. That's for sure.
Right.
So
great point.
Yeah. And so when you look globally, almost every single market index is at an all-time high. So what am I going to do? Sit in cash? Many people do that.
And did after, like a big downturn, they do that. They panic.
100%.
Yeah.
And what many investors fail to realize is that if you study the data and you say, am I better off buying when the market is not at an all-time high or if it's at an all-time high? Surprising to many, you are better off if you only invest at the times that the market is an all-time high. If you invest on those days versus days that it's not. Well, why is that? Well, because the market can get very streaky. So a lot of times when it's going up, I'm buying it on a day it's going up. It's up 80% of the time. So if I'm buying on days that it's up, I tend to get more winning days than when I'm buying on days that it's low. And so again, that's a foundational data set that I think is important to understand that kind of tees up the rest of our conversation. Again, if I study the data would tell me if I buy the market when it's at its most expensive, that tends to outperform when I buy when it's not. And so when we look at what does it mean to have an expensive market? One thing I think that is common is there's a data side and then there's almost like a qualitative emotional side. I think the emotional side is I'm paying more for something than I've ever paid. That's what makes it feel so expensive.
Yeah.
And that could be your home, car, stocks, whatever. But specifically to the market, because that's what we're talking about today, it's at an all-time high and I'm getting less shares for the same amount of dollars than I used to get. And so that makes it feel expensive because it's at an all-time high. The other way to look at it would be, using some sort of PE ratio, price of the company stock versus the earnings, or price of the index versus the cumulative earnings of that index.
Yeah, and lots of conversation about how so many companies are overvalued, and the PE ratios are crazy.
Yes, and that gets very challenging. And if you look at any great money manager over their lifetime, they would tell you PE ratios are not a good indicator of future earnings or future price.
Okay.
And Warren Buffett's infamous for talking about that. Hey, what's really going to drive the future stock price is the future earnings of that company. And when we're looking at a PE ratio, that's off of previous earnings. Previous earnings are not the end all be all for future earnings, especially when the economy is growing. When the economy is growing and the market is growing, we're looking at past earnings when we look at PE ratio, but the P there, the price, is what the market thinks we're going to get off of future earnings. So this is where the PE ratio can be really misleading for investors.
Yeah, and it's easy to get lost in that, right? Again, because it's making all the headlines with these PE ratios.
100%. And even Warren Buffett is infamous for saying PE ratios are a terrible way to, determine whether this is a good buy or not. The only thing that matters are the fundamentals of the company. What is their cash flow? What are they profitable? What are the fundamentals of the balance sheet look like? And do we think their earnings are going to grow?
Yeah.
So if it's a good fundamental company, well managed, and the earnings are going to grow, we should buy that stock. That's what they believe.
Well, a lot of people, Scott, I think average investors and whatnot feel like there's two things they can do. They can be in cash or they can be in the market. And the market is typically what the news talks about, which is the S&P 500.
I think it's a great point. And I think, to me, have a ton of our money in cash, to me, is very risky because of missed returns and because of inflation. And it feels safer, but we're not understanding all the risk we're taking by just sitting in cash. And to your point, there's more than one market. The S&P 500 is, we use that as an indicator for what the market is doing. There's all sorts of markets. S&P 500 is very tech and growth heavy right now. We have other markets.
Well, yeah, the Mag 7 run it all.
It's 80% of the market. It's really like
Right.
the S&P, 10 really. And, ultimately, if we look at international holdings, value holdings, dividend stocks, there's many other markets we can participate in. That we recommend you participate in that are potentially not as expensive or not, quote unquote, overpriced. And through having a diversified portfolio, we're able to get these assets that are going up and down at different times. And through rebalancing, we can stay invested and manage risk effectively. And ultimately, when people are going to cash, they're viewing that as a way to manage risk. This is too expensive, therefore I'll sit in cash so it doesn't crash and I don't lose a bunch of my money.
There you go.
And especially for our folks that are 55 and older, 60 and older, getting close to retirement, they remember 2008, 2009. They remember the S&P 500 going down 57%.
Yeah, if you're 60, that happened when you were 40, basically. We're almost coming up on 20 years, right? And so, it bothered you. It was a lot of money, but you were 40. So you were like, well, I got a lot of years to work. Well, now you're 60. It's a different animal.
I was just talking to somebody the other day, man, I remember losing 45% of my portfolio, like you said, in my 40s. And I can't.
That sucks bad enough.
Do that again. I can't.
Yeah, right.
And, I hate that for people because that's probably led towards, them potentially sitting in cash longer than they should and missing out on a lot of returns. But what it drives to is we need to have a plan. We need to have a plan. And that plan can drive how much risk I need to take with my portfolio. And again, when we're talking about managing risk, we're not talking about just sitting in cash. We're talking about not having all of our eggs in one basket, not being all in on a handful of stocks or one market index, but
chasing the higher return, right? I mean, like trying to get 10% out of something when maybe 6 or 7 or 8 drives the strategy.
100%. And, ultimately, when we look at, things going really, really well, let's say this last decade plus, returns have been pretty good, apart from a couple of years and a couple of short little bear markets we've dealt with. That doesn't necessarily mean returns are going to stay that way either. And so, to me, just because the market's expensive doesn't mean we shouldn't buy it, but we should buy it knowing that just because it went up 20% last year doesn't mean it's going to go up 20% next year either.
Yeah.
But what we don't want to do is sit on the sidelines and miss out on a bunch of returns waiting for that dip, right? If I'm here and the market goes up 20% over a couple of years and then it dips 10 and I buy that dip at 10%, I can feel really good. Like I knew it was going to go down.
Yeah. I got me a sale.
But I'm ignoring the fact that I still missed on that other 10%. Yeah, maybe bought it 10% off its high, but I missed out on that other 10% of growth and all that time I was sitting on the sidelines. And Mark, that's ignoring dividends. Dividends make up 30% of the total return of a portfolio typically. 30%. And so when we're in cash, we're not getting dividends. Okay?
That's true.
We're missing out on the growth. We're missing out on the dividends. And guess what? When the market comes down and my dividends are getting paid right into the portfolio, my dividends and my contributions are buying that down market. I mean, that's how we don't want to disrupt the compounding machine. Okay. So, to me that this is it's more of a mindset shift that the investor needs to go through and understanding that things are going to be expensive when they're going up in value. And I want to participate in that going up in value. And that means I need to buy these things that are quote unquote expensive. Now, we can do that in a smart way, right? And we talked about it a little bit earlier through being diversified. And I like using this example of 24 into 25. So end of 2024, we had finished a couple years of more than double the average return on the S&P 500. So if I can take some of that and look, well, international has been lagging and my S&P 500 holding has ballooned in 2 years by more than 40%. That doesn't mean I shouldn't buy more, but that might be a good time that I want to maybe skim some of those profits and buy something else. I don't want to go to cash, but I'm going to just at least go to a different asset class that maybe has underperformed this asset class, even though that asset class might still be expensive for it too. And when I do that, I bring the portfolio back in balance. And then what happens in 25? this tariff communication comes out, S&P 500 goes down about 20%. International's up about 15%. Now I have a 35% swing on those dollars. That might be a good time again to go, hey, with my event-based rebalancing, this is kind of an anomaly of volatility. So let's take a look and skim some of that international, buy my large cap US stocks and bring the portfolio back in balance.
Yeah.
And then what happens a week later? The president sends a tweet out, hey, we're going to figure this tariff stuff out. And in 2 days, remember in 2 days, the S&P went up 12% in 2 days.
Yeah.
And through rebalancing is how we can manage risk. Okay. And then based off of my risk profile, we know what assets we need to have in there to keep the rebalancing and keep that volatility under control. So, there's definitely a way to do it, but we shouldn't let an expensive market that's performing really, really, really well be a reason to get us out of the game, so to speak. Again, if the market, quote unquote, the market S&P 500 is really expensive, yes, maybe I don't put my entire $3 million portfolio in it when I'm 62 years old. I agree.
Right.
But that doesn't mean that I sit all of that in cash out of fear either.
And you got to outpace inflation. And I mean, all those basic things we know anyway, right? So, and to your point, you're talking about Buffett earlier. He's like, look, if you can't handle being in it for 10 years, don't be in it for 10 minutes. You know?
I mean, and you hear Munger say all the time, like, hey, 3 separate times I've had my portfolio get cut in half and I'm okay with it.
Right.
Yeah, because he's in it for the long term. And, to me, those guys are also institutional investors.
Sure.
So that's a little bit different than
different animal. Yeah.
Somebody who's getting ready to retire that isn't going to have future income. So I understand that for sure. And again, an institutional investor whose portfolio gets cut in half, they can go do marketing and sales to get more people to buy into their fund. Okay. The person who just retired, whose portfolio got cut in half, is no longer contributing to that portfolio. So those are two very different mindsets for sure. But, to me, I think the mindset shift is really around a couple of things. Okay. First off, if I grossly underperform and don't compound my contributions, how much less of my retirement am I going to be able to enjoy? So that's one mindset shift of how do I get a better retirement through a better investment plan? The second would be, yes, the market's done really, really well the last 10 years. So what if it doesn't do quite as well? We have this thing called recency bias where, hey, things have gone really well for 10 years. I think it's going to do the same the next 10 years. We don't know that. So what if the returns are maybe a little bit less for the next 10 than they've been the past 10? And then the last thing to get our mind around is, what if there is some sort of recession and market crash? Typically, we see every few years, the S&P 500 is going to get cut by about 20%. That's a bear market, very, very normal. In a recession, when there's a recession with a bear market, we tend to see the market go down 40%. And again, that's the S&P 500. So if you're one of those guys or gals that are all in on S&P 500, you okay with it going down 40%? Okay. But if not, you should have a plan for how we diversify out of that to make sure that we're not going to capture all of that downside without tricking ourselves into becoming market timers where we're going to get in and out at the right time.
Yeah.
And so to me, there's a handful of different mindset shifts there where, yes, we're buying something that's expensive, but we're going to do it in a way that we're diversified. We have assets that are not correlated with each other and that we can use rebalancing to our benefit to manage that risk effectively without feeling like my way of managing risk is just being scared of it and being over in cash. And we're missing out on dividends. We're missing out on growth. And we're ultimately going to deliver a lower standard of living in retirement than we could have.
Well, Scott, you talked about the 10 years and how it's been growing. And it's like, if you're trying to figure out, when to get in because it's expensive, Yahoo Finance, I pulled this up for you. Over the last 10 years, the S&P 500 has achieved an aggregate total growth of roughly 216% in 10 years. So you'd be waiting 10 years to figure out when it's going to be on sale, right?
Yeah.
So it's like, again, you're trying to market time. There's no ideal time to jump in or jump out. You don't have that crystal ball to use all the cliches. So
absolutely. And again, that's where I think the strategy around being diversified and then not actively managing the portfolio, meaning we're not turning over the holdings all the time,
right?
But actively managing the rebalancing of the portfolio can be a huge way to get some investment tailwind and manage risk at the same time. Okay. And again, through owning different asset classes and then keeping our finger on that, quarter to quarter, month to month, sometimes day to day, can really help drive some of that smoothed out investment performance and mitigate a lot of the downside risk, because we don't have all of our eggs in one really expensive basket. Yeah. But I'm going to go back to the very first point I made. Just because it's expensive doesn't mean we shouldn't buy it. The data would tell us you're better off investing in the market when it's at an all-time high. So that still is, the data would support that philosophy. However, I do think we can get better long-term returns by, being diversified and managing the ups and downs with a little bit more intent.
Well, and as always, if you need help with that, before you take any action on something here on our podcast or any others, you should always talk with a professional about your specific situation and run those numbers, run those stress tests, check out different ways of looking at things to see what's going to be ideal for you. And you can do that with Scott by simply just clicking on one of the links down below, getting some time onto his calendar and having a conversation for yourself, building a strategy for yourself with Scott Osborn here. So, Scott, thanks for your time, my friend, and breaking it down. Always appreciate you.
Hey, good to be here. Have a great day.
We'll see you next time here on the Wealthy Pilots Podcast. Don't forget to subscribe to us on Apple, Spotify, and of course right here on YouTube. We'll catch you later.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.